In this video, I'm going to cover the 2023 Roth IRA and traditional IRA contribution limits, as well as some strategies to help you get the most out of deciding which contribution is best for you. Welcome back. This is episode 193. As we get closer to the 2023 tax filing deadline, which is April 15th, I wanted to discuss contributing to a Roth IRA or a traditional IRA for 2023 and how this could save you some money in taxes. And before we get into that, as a reminder, if you're serious about putting a plan together for your retirement, then consider signing up for my in-person or online retirement planning course, Retirement Readiness Review. If you live in Connecticut, consider attending one of my in-person courses, which are going on now, and there's still some room, so sign up before they're completely filled. Or if you live further away, consider signing up for my on-demand course where you can go through at your own pace. To learn more, head over to retirewithryan.com and click on courses. So let's start with some IRA basics. And everyone who had earned income in 2023 has an annual amount that they can contribute between an IRA and a Roth IRA for 2023. Now, you still have until the tax filing deadline of April 15th to make your contribution, even though we are now in 2024. And the IRS defines earned income as wages, salaries, tips, and net self-employed income. The only exception to this is that if you're married and you file your taxes as married filing jointly, then your spouse can make a contribution on your behalf if you didn't have earned income in 2023, but your spouse did. So what doesn't count as earned income would be Social Security income, pension income, IRA distributions, dividends, interest. That doesn't count as earned income. So in 2023, the annual amount or the maximum that you can contribute is $6,500 if you were under 50. And if you're over 50, you can actually contribute an additional $1,000, or it's known as the IRA catch-up, bringing your total contribution up to $7,500. And you can choose to contribute all of that to a traditional IRA. You could put all of that into a Roth IRA, or you can split your contributions in any amount you choose. However, the ability to contribute to these IRAs is based on your modified adjusted gross income, or your MAGI. So let's start with making a deductible IRA contribution and how that works. So if you're looking for an additional tax deduction for 2023, then you may be able to contribute to a traditional IRA and get a tax deduction equal to the amount that you contribute up to the maximum limit of $6,500 or $7,500. So what determines your ability to contribute to this account and take a tax deduction is two things. The first is, are you covered by a retirement plan through your work? And the IRS defines a retirement plan as a 401k, a 403b, a 457 plan, a profit sharing plan, a money purchase plan, a stock bonus plan, a SEP, a SAR-SEP, a simple IRA, or a pension plan. So if you're covered by any one of those plans or you contribute to one of those plans, then you have to then look at what your modified adjusted gross income is to be able to make that contribution and make a deduction as well, or take a deduction on that contribution. If you're not covered by a plan through work, then there is no income limit for you to be able to make an IRA contribution and take a deduction on it. So it's based on your tax filing status. So we'll start with single. So if you're single or head of household and your modified adjusted gross income is less than $73,000, then you can make a full deduction to an IRA. If you're single or head of household and your modified adjusted gross income is up to $83,000, you can make a partial deduction. And if you're filing single or head of household and your modified adjusted gross income is over $83,000 for 2023, then there's no ability to make a deduction or take a deduction on your contribution, I should say. If you file married filing jointly and your MAGI is less than $116,000, you can also make the full contribution and take a full deduction. If you're married filing jointly and your MAGI is less than $136,000, you can make a partial contribution and a partial deduction. But once you go over $136,000 as a married couple filing jointly, you can no longer make a contribution or take a deduction on that contribution. If you're married filing separately, the IRS really penalizes you because if your income would have to be less than $10,000 for you to make a partial deduction. But once it goes over $10,000, you're no longer able to make a contribution and make a deduction. And if you find yourself in between these limits, but not over the upper limit that I mentioned, there's a calculation the IRS does as far as calculating a prorated amount. And I will put a link for all these numbers in the show notes so that you can access that. To find that, you go to retirewithryan.com. So if you want to take a tax deduction and your modified adjusted gross income qualifies you for that tax deduction on your IRA contribution, then you can do that. And in order to do that, just be aware that you need to not only make the contribution by April 15th, but you also have to note it on your taxes. So if your MAGI is over the amount allowing you for a deduction, then your next option is to make a Roth IRA contribution. With Roth IRAs, you don't get a tax deduction on the contributions. However, when you take the money out of the Roth IRA, the withdrawals are tax-free. As compared to an IRA contribution where you're getting a deduction, in that case, the withdrawals are all going to be taxable. So to be able to contribute to a Roth IRA, your modified adjusted gross income also has to be under certain limits depending on your tax filing status. If you file single, head of household, or married filing separately, and you don't live together at all during the year as married filing separately, your MAGI has to be under $138,000 to make the full contribution. If you file single, head of household, or married filing separately, also not living together, under $153,000, you can make a partial contribution. But if you file single, head of household, married filing separately, and you don't live together again, and your MAGI is over $153,000, you're not allowed to make any contribution to a Roth IRA. For married filing jointly or a qualifying widower, and what is a qualifying widower? That is if your spouse passed away in the current tax year and you haven't remarried, then you're able to still take advantage of the married filing jointly tax brackets. So in that case, if your modified adjusted gross income is under $218,000, you can make the full contribution. Married and filing jointly or qualified widower, up to $228,000, your contribution is reduced. And then once you go over $228,000 as a married filing jointly or qualifying widower, your contribution is reduced to zero. If you file married filing separately, but you live together at any time during the year, then in your modified adjusted gross income is over $10,000, then your contribution is completely reduced. But if your MAGI is under $10,000, you can make a reduced contribution. So again, I'll put a link to these numbers in the episode notes. Just go to retirewithryan.com. So let me briefly talk about a spousal IRA because I mentioned that earlier. And this is if your spouse had earned income in 2023, but you didn't, and you file married filing jointly, and your modified adjusted gross income is under $218,000, then you can make either a Roth IRA contribution or a deductible IRA contribution. And you could also make a combination of the two up to the limit. So just to reiterate, you don't have the ability to make a contribution of $7,500 if you were over 50 to a Roth IRA and a traditional IRA, the $7,500 between the two of them. So there is no special IRA for a spouse or a special spousal Roth IRA. It's just an IRA or a Roth IRA in your spouse's name. And you'd be making a contribution into your spouse's account if you're the one who has earned income. And so they would need to open a traditional IRA or Roth IRA in their name to receive that contribution. And I recommend using Schwab, Fidelity, or Vanguard as your company of choice to make these contributions because I find that those companies have the best IRAs as far as low cost, great investment options. So what if your modified adjusted gross income is over the Roth IRA thresholds we went over? You have a high amount of income in 2023. then what are your options? So then you can make what's known as a non-deductible IRA contribution. So this is where you make a contribution to a traditional IRA up to the limit of $6,500 or $7,500, but you don't actually get a deduction on the contribution. So why would you want to do that? Well, I can think of 3 reasons why you would want to do that. The first reason is that if you want to pursue what is known as a backdoor Roth IRA, I've talked about that in past episodes, and this is, again, you make too much money to directly contribute to a Roth IRA. If that was the case, you could potentially make what's known as a backdoor Roth IRA. And the way that you would be able to do this is that if you didn't have any IRA, SEP IRA, or simple IRA money in your name at the end of 2023. If you did, then this doesn't work, and you'll have to do some things to maybe change that for 2024. So if you didn't, however, have that money, then what you would do is you would open a traditional IRA and a Roth IRA at the same company. You contribute to a traditional IRA for 2023, and then shortly after making that non-deductible contribution to that traditional IRA, you have the money moved over to the Roth IRA, and this is considered a conversion. And because you don't have any other IRA monies in your name, it's a tax-free conversion. So that's what a backdoor Roth IRA is. I'll also put a link to an article on how that works in the show notes as well. Reason number 2 that you would want to contribute to a non-deductible IRA is that, let's just say you can't do a backdoor Roth IRA. You have a simple IRA or SEP IRA and you don't want to change that, or you can't change that. In that case, you would still benefit from the tax deferral that the traditional IRA would give you. Well, what do I mean by that? Well, once the money is put into the IRA as a non-deductible contribution, any increase in value on that money that occurs from dividends, interest, or capital gains is deferred. The taxes on that money are deferred, and then when you take the money out, you will pay tax on the gains that you've incurred on that money, but you'll never pay tax on the principal. So that could be beneficial to you as compared to just investing it in a brokerage account where you would be paying taxes on an annual basis potentially on any dividends, interest, or capital gains. The third reason to contribute to a traditional IRA for 2023 is that if you have a 401k through your company that you work at some point you can roll the after-tax money gains over to a traditional 401k, therefore separating your contributions from your gains, and then convert your contributions to a Roth IRA in the similar fashion that you would do a backdoor Roth IRA. Now, I covered this in greater detail in episode 181, so go ahead and look up that episode if this is something that you want to learn more about. But those are 3 reasons why it could make sense for a non-deductible traditional IRA contribution for 2023. So definitely look into these 3 options, whether a traditional IRA is going to make sense for you in taking a deduction on that contribution, whether the Roth IRA is going to make sense for you, or doing a non-deductible IRA as well, or if you qualify for a spousal IRA, that is an option too. So definitely check out those options. Speak to your financial advisor or talk to your accountant. As always, if you have a listener question, feel free to head over to retirewithryan.com and click on Ask a Question, and I'll consider that for a future episode. Have a great week, and I look forward to talking with you next Wednesday. Take care.